Hello everyone, thank you so much for coming to this session today. My name's Laura, I work for Experian. And just in case you're starting off by wondering what are Experian doing at REBA, I thought you were the lot that helped me to get a mortgage. Yes, traditionally Experian are a credit reference agency. I'm not here to talk about credit scores today or credit scores for your employees, but over a drink I can give you some tips. I'm here to talk today a little bit about how we are using data in different ways to measure the impact that the economy is having on employees, and also tell you a little bit about something that Experian is doing to try and help your employees to support financial inclusion. A little bit about why we have expertise in this area. 2 in 3 lending decisions in the UK are powered by either data from Experian or platforms from Experian. We've helped 4 million UK consumers, probably a large number of your employees, to get greater visibility in the financial ecosystem, including 2.3 million people being able to boost their credit score by utilising things like data about how regularly they pay their council tax on time through open banking. So what are we going to talk about today? I'm going to talk a little bit about some of the economic factors that may be impacting your workforce, and I'm going to share a little bit about how employees are reacting to these factors. We're then going to talk a little bit about financial inclusion and some of the struggles that some of your employees have when they are trying to access finance as a way to make ends meet. I'm going to hopefully leave you with some considerations for your business and then share a little bit about what Experian are doing to try and help your employees in these circumstances. Okay, so let's get kicked off. Economic situation. Salaries are increasing. But they are falling behind inflation. Probably not necessarily new news here. I think we've got the 2 measures on screen for over the last 4 years. Salaries have increased in the UK by 19.8%. Big jumps in 2022, 2023, when the cost of living crisis was obviously front of mind for yourselves as reward professionals, big pay reviews, interventions to help support the cost of living crisis. But inflation, CPI, which doesn't include mortgages and housing costs, is just ahead at 20.2%. When you factor in the cost of housing, RPI is sitting at 27.4%. Talk a little bit about the cost of housing. And I think this is the real standout piece for me. Yes, mortgages are expensive. That's not new news. We've known that for quite a while. Mortgage debt is steadily increasing. At the same time, interest rates are steadily increasing as well. And so employees are feeling the pinch in terms of those housing costs. But what is really rising quickly is the cost of renting. Now, the median rent, according to the Money Charity in London, is over £2,000 a month. For outside of London, 1,300. So that's quite a significant strain upon your employees, especially factoring in that those pay rises, whilst brilliant, have still been slightly behind inflation. Wider, there are still cost of living pressures. I'm not going to say that this is cost of living crisis. I think we can take the crisis bit out of it. It is just blanket the cost of living for employees. Costs to fill up your car with petrol have gone up. Costs of food have gone up. Costs of public transport. All of these steadily increasing, putting more pressure upon our workforce. So how is this impacting consumer behaviour? Really interesting anomaly here, first of all. Taking aside 2021, where there was literally nothing we could spend our money on because we were still in lockdown and people put a lot of money into savings, we have seen people steadily putting more and more money, on average, into their savings, which is great. This is really good behaviour that we want to see. However, the number of people with £1,500 or less in their savings has also increased. So that's a bit of a weird anomaly. What this suggests to me, and I'm not an economist, is either people are putting money into their savings, they're being more conscientious month to month, but then big ticket expenditure is causing them to dip into that savings. So overall, at the end of the year, they have less than they started the year with. It could also be that a number of people who were paying in 2 to 3% on average have stopped paying into their savings. So overall, the weighted average, the amount of savings has gone up, but the number of people saving may well have gone down and is skewing those figures. Average household debt is also steadily increasing. This is unsecured debt, so taking out mortgage and auto finance. The blue bar is the credit card portion of overall unsecured debt. That is increasing behind its CPI that we should look here as the main measure, because most people don't put their mortgage or their rent on their credit card. So overall, a 14% increase in unsecured debt. However, the debt on the credit card has gone up by 23.4%, which would suggest that this is not just that they're putting the same amount of day-to-day spend through the credit card. More money is going onto their credit card than previously. And this plays out in some of our stats from Experian. So 40% of UK adults have opened a new line of credit in the last 12 months. We've seen an increase in the amount of subprime, which is small level loans, and 28 million applications overall for credit in the last 12 months. One of these uses of credit is buy now, pay later. The use of this is growing exponentially month on month, 15% month on month growth in transactions. Every age group is utilising buy now, pay later. It's not just the young ones. It's actually millennials who are the largest users of it. It is being used on top of traditional credit. So as well as putting money on the credit card, people are utilising buy now, pay later. Now, a lot of people are using this really considerately. People are using it for that easy click and split the balance into 3 equal monthly payments. People are also using it for multi-product purposes. So how many of us have gone online, shopped at ASOS, have to buy a 10 and a 12 or a 12 and a 14 because you're reliably a ladies size 11 or a ladies size 13? That is where a lot of people are utilising buy now, pay later as well, knowing that they are going to return some of that product, and so they're going to get some money back. However, people are starting to be stung by late payment fees on buy now, pay later. Over half of people have been charged some form of late payment fee over the last 12 months. So we can see across the age groups, people are opening more finance lines, they are having more access to credit. So a little bit of a confusing graph here, but the orange bar shows the average number of credit-based accounts that a consumer had in March 2019. The blue bar is in March 2023, and the pink bar is in October 24. So as an example, if we take the up to 24s, what we can see is in March 2019, the average person had about 3.1, 3.2 credit accounts. Fast forward to October 2024, that's more like 4.6, 4.7. I want to just talk a little bit more about buying a home, because there's some really interesting stats coming out of this that may well affect your retirement planning. The average age that someone will pay off a mortgage in the UK is now just shy of 64. If you're in London, it's 3 years longer. This is driven by, A, people are getting on the housing ladder later into their 30s, but also to make that mortgage affordable, they are taking extended terms on the mortgage. They're taking the 30 or 35-year mortgage terms. Previously, only about 1 in 10 people took a 35-plus year mortgage term. We're now seeing it's 1 in 4. In 2023, the average repayment age was 60. And the year before that, it was 57. So this is going up and up and up. And a lot of people are going to be paying off their mortgage into their retirement. So what this might mean is in that time when your reward strategy and your communications to your workforce would be encouraging them to put more money into their pension, they may not be in a position to do that anymore because they're still paying a mortgage. And actually only 30% of people say that they will pay off their mortgage just by making monthly instalments from their salary. 70% of people, their plan to pay off their mortgage involves either receiving inheritance or paying it off in some way with their pension. So now let's talk a little bit about supporting employees who are turning to credit. To access credit, employees have to prove where they work and what they earn. Obviously, the big one, buying a home, we're familiar with having to download payslips, get a letter from your HR team saying that you work there, you're on a contract, that you haven't given in your notice, etc. But actually, it's the smaller bits as well. It's renting and needing to prove your income and potentially get a letter from HR. It's getting a credit card. It's getting car finance. It's buying a sofa from DFS. Other sofa retailers are available. These aren't just one-off occurrences. We actually estimate that the average employee will go through 1.4 verifications in any year that require either their income or employment as a piece of information to their provider. Now, in these moments, 10% of UK adults face financial exclusion because they are what we call credit invisible. I said I wasn't going to talk about credit scores. I'm going to talk a little bit about credit scores. So as you have probably known, Martin Lewis talks about this all the time. When you're applying for a mortgage, you need to get a really high credit score because then that increases your likelihood of being accepted. Your credit score is an indicator to the lender of how risky or not it is to lend you money. So obviously, if you've got a good score, and you're going to be great with money. If you're not great with money, you've probably got a bad score. But 1 in 10 people have a thin credit score. It means they don't have enough evidenceable history of managing money for a lender to be able to make an assessment on them. In those scenarios, if you have a thin credit score, and again, it doesn't mean that you are bad with money, but you could be refused credit outright, you could be given credit but at a lower level, or you could be charged more interest to mitigate that risk. Now, who this is really affecting is young people who just haven't had the time to build up that profile. So think about your intake. Do you have a graduate scheme? Are you recruiting school leavers? Because those people are the thin credit files who may well struggle. The other thing is new to country. Credit scores and credit profiles are not transferable across country borders. So what that means is if you've got somebody coming into the UK, maybe through global mobility, you're bringing someone from another region over to the UK. If you're hiring professionals, skilled workers, if you're in the healthcare industry or the social care industry, there's a lot of non-UK nationals coming in the UK to work. Again, they have a thin credit profile. They may well struggle. What it means, the impact of them throughout their life moments, is things like being made to pay 5 months' rent in advance in order to rent a property. It means that they can't get a long-term mobile phone contract and they have to get a short-term one, which means on average they'll pay over £200 more than someone who had a credit profile and was able to get accepted for that contract. So as I say, you can see the impact that this is having on those employees who are having to turn to credit to make ends meet, but may struggle if they have a thin credit profile. So millions of UK employees either missing out on favourable pricing on products, or they're facing a really frustrating process to verify their income. A lot of income and employment verification, as you probably know, is quite manual. You're sending payslips, you're requesting proof of employment letters from HR, and there may be a bit of a turnaround time for those. So, some questions to consider for your business. Firstly, retirement planning. Is the support that you're giving employees in the lead up to retirement factoring the fact that many of them will be still paying off their mortgage into retirement? If you're employing new to country professionals, or if you've got a graduate scheme and you're employing school leavers, are you giving them any support to help them to have the knowledge to build that credit profile? And how are you supporting employees to get access to finance when they need it, knowing that they are in a position that they're turning to credit? I would ask you one more question, which is, are your employees empowered to easily prove their employment and their income, or are they waiting 5 to 7 days for HR to turn around a proof of employment letter? Because in the Northwest, when a rental property goes online, within 24 hours it's getting 6 bids. So the competition is really fierce, people need to be rent ready. You wouldn't want that to be the reason that the employee is missing out on a rental property because they haven't been able to get that proof from HR that they are in full-time employment. So I'd finally like to share a little bit about why Experian are here talking about this today and what we're doing to try and help solve this problem. 2 years ago in the UK, we launched a service called Work Report. Work Report enables employees to digitally share their income and employment with a third party from the source of the HR or payroll system used by their business. It helps support financial inclusion for the workforce by enabling them to quickly share this verified digital information. It also helps to reduce HR administration and HR effort because those manual requests for employment references are being removed. A key part here for this audience, this is a free of charge service for you to implement. There is no direct cost to you in joining this network. There is no cost to the employee. And I'll come on just briefly in a little bit as to how it works. So as I say, we have built a connector that bridges the data gap between those third parties who need to know about your employee's income and employment status and the HR and payroll systems being used in your business day to day to manage employees and process payroll. So we've partnered with the organisations that you've seen on screen. Through those organisations, over 1 million businesses are today able to connect to Work Report or will very soon be able to connect. And that is today benefiting over 16 million employees. How it works, so when an employee is applying for finance, they might be on the Nationwide website, for example, they're asked to verify their income and employment. At that point that they would normally upload payslips, they're given the option to digitally share their data. They give their explicit consent for the information to be pulled. The information is only pulled by that employee. By joining Work Report, you're not giving your entire workforce data to us. It's not impacting credit scores. The employee consents to share. Work Report pulls the minimum information required from your payroll system to fulfill that request. And then the employee consents to share that with a third party. It's only shared on a one-time basis. So if you're doing a mortgage application with Santander and then you apply for a credit card with Santander, they have to go through that consent process again. So we've built GDPR really into the heart of this service. With Work Report, everyone benefits. So our new to country professional, Maria, she's not having to pay those huge upfront rental deposits. She's getting access to fairer loan rates because she can evidence her income and employment digitally in real time. Our George, going for a mortgage, is not going to have to wait 6 weeks for his mortgage application to be manually reviewed to check for fraudulent payslips, etc. It's going to speed up his mortgage process, reduce the risk of him losing a property or a mortgage product because while it was in review, his product has been pulled or potentially he's been gazumped. Work Report is also used by background checking companies. So in terms of employment tenure checks. So we can automate those through the service, again, reducing those amount of manual references that have to be chased and enabling job seekers to go through that onboarding process quickly. And hopefully reducing the amount of time that the HR teams are having to spend generating those letters manually. So how you can connect to this service, as I say, if you're using any of the products on the left-hand side of the screen, you're either able to connect today or you will be able to connect soon. Some of our partners are still rolling out this service to some of their different products. If you're using SAP, Oracle, or Workday, we have developed or are developing connectors for these solutions, so please come and speak to us today. You can see us in the very bright pink T-shirts. We're quite hard to miss, but we are just outside. If you turn left, you'll see us handily next to the men's loos. We've been directing everyone to the women's loos all day today as well. If you're not using any of these products in your company, please come and talk to us. We are in talks with a few other providers that I obviously can't mention today, but if you come and mention the name to me, I'll give you a wink or a nod. Or we can take your details and then look at how we can integrate with that provider. I've got 4 seconds left on my screen, and that is the end of the presentation. So thank you very much.
Well done.
Very happy to take questions.
Thank you.